Hi, this is Jim Cunningham. We're going to talk about business succession planning for CPAs. So if you're a CPA watching this, pay attention because we got some good stuff in here. So we're talking specifically about CPA practices and the rules involved and what that looks like. And there are four ways, just as a spoiler alert, there are four ways that you can transfer a CPA practice. So what is business succession planning? If you're a CPA, I hope you know this already, but I'm going to kind of take it from the top. It is the creation of a process for the future transfer of leadership, ownership, and management of a business, and I include in there a CPA or other professional practice. This is at retirement, incapacitation, or death of the owner or key people. So key personnel, whether you have a right-hand person or maybe somebody who's above you. You might be watching this thinking, hey, I'd really like to take over the partner I'm working for, that partner's practice. How does it all work? That's what we're going to talk about here. We're talking about the peaceful transfer and continuity of the business, minimizing its disruption and minimizing hemorrhaging of clients, because many times the principal CPA, right, in a CPA practice, when that professional leaves, a lot of clients go too. So very important to pay attention to that. And planning helps avoid unnecessary, avoids uncertainty and preserves the business value and ensures that the business can continue when there is a change in ownership. So let's look at an example. Charlie CPA. We're going to talk a lot about Charlie CPA in this video. Charlie CPA spent years building up Charlie CPA practice really from the ground up. But what happens to Charlie CPA practice if Charlie never gets around to any business succession planning? And in our firm, we talk about getting hit by an ice cream truck. Now, if you prefer beer, you could get hit by a beer truck. Whatever you prefer to get hit by, whatever floats your boat. But what we're talking about here is if Charlie gets hit by this ice cream truck, and dies or doesn't die. So that can, as you know, can be a much more significant problem if the person does not pass away, because you have extra issues you have to deal with. The family really is left to pick up the pieces, and it is going to probate court. If you don't have a plan, even if you have a will, at least in California, you're going to probate court if you don't have a living trust in place and a succession plan typically. Charlie should have a plan to avoid these disasters. What can Charlie do before, really as a CPA, what can you do before you get hit by the ice cream truck? And what can your clients do, right? If you're a CPA counseling other clients, what can those clients do as well? So key aspects Charlie should consider is the exit strategy itself and the timeline. How is Charlie going to leave? There are four primary ways of transferring a business. It's an internal sale, an external sale, passing it to heirs, or simply closing the business. And we have names for those that we'll talk about. Training and development. You need to prepare that next generation of leadership to take over. And if you are a CPA close to my age, and as we're recording this, I'm 55 years old, there aren't a whole lot of young CPAs entering the practice. So it can be really challenging to, how do you transfer that institutional knowledge from one generation to the next? Because you really want to make sure your clients are taken care of. And you need to make sure you have people in there if you're going to do some type of internal succession where you're bringing on people. Valuing the practice, if you go online, you can see the valuation tools. I think broadly speaking, what we're seeing is a 1x multiple on valuation for private transactions. So transactions that happen between parties. That's a lot of what we're seeing, kind of a general rule of thumb. Financial security for retirement. If you're a CPA and you have not put away enough money for your own retirement, this may be a source of funds for your retirement, and that can really be an extra added challenge on how to fund this retirement. And tax and legal considerations. You have to structure the plan ideally to minimize taxes and ensure all the laws are followed. They're not only your various state laws, but you also have ethics rules with respect to with CPAs. This does necessarily involve wills and trusts and buy-sell agreements. And valuing the practice, again, the current value, the future value. If you bring on a person who helps you build the practice, are they just sort of building up the value for you that they're going to have to buy you out on? That should be covered in a buy-sell agreement. Funding the transition. How are you, if you're the seller or if you're the buyer, how are you going to come up with the money, right? If you're paying someone $1 million for a practice, and you have to earn $1 million, at least in California, you got to earn $2 million, right? Because then you got to pay your $1 million in taxes in order to give that $1 million to the seller. So, how are you going to fund that? Is it going to be on funding it from after-tax income? Is it going to be life insurance? And we'll talk a little bit about how life insurance works with buy-sells. And then what? So if you're the exiting uh, professional CPA, congratulations. But what are you going to do in the next chapter of your life? Many people are lifers. They never give it up. They die at their desk, or, literally or figuratively. And, if that's you, then I guess you still need to think about this, because at one point you're going to just leave a mess for your family. And if you're not a lifer, if you do want a life after accountancy, you got to figure that out. And I would recommend that you figure out, and this has nothing to do with business, but like, what are you going to do with your life? Right? What's the next chapter in your life? I think that's really important to think about. I'm an attorney. I'm a partner at Cunningham Legal. I've been an attorney for 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law, real estate broker, securities, insurance licensed, and a pilot single engine land instrument rated. A lot of interest there. And we have 17 attorneys currently in our law firm. We handle all things estate planning, business planning. I have a couple attorneys devoted to real estate, so we help a broad variety of clients, including CPAs. And these are our office locations in California, Northern and Southern California. So this is very important. I'm a lawyer. I'm talking. This is not legal advice. Please don't take this, construe this as legal advice. This is really something you need to speak with one-on-one with an expert lawyer, right? Someone who has a degree of expertise in this, who kind of knows what not to do. But really, you do need legal advice. This is not a do-it-yourself. And I know there is an overlap and a crossover oftentimes with CPAs and attorneys, if you're doing corporate formation and S-corp elections and all those other things we do. But really, this is a lot of what we're talking about here is the purview of a lawyer, and it really makes sense to hire a savvy lawyer. So let's talk about legal considerations specifically for CPAs when they exit a practice. So we have the American Institute of Certified Public Accountants, the AICPA, and their professional ethics division. They have a code of professional conduct. And in it, there is a discussion of transfer of files and return of client records in a sale, transfer, or discontinuance or acquisition of a practice. This is Rule 1.400.205, became effective in 2017. This explains what needs to be done with client files, really client property, if you can think about it in that way, when selling or transferring a practice or part of a practice, or discontinuing it. So remember, that property is not your property as a CPA. That is the property of the client. And there are specific rules. There are some parallel rules for lawyers, so we're very familiar with these in transitions of legal practices. But it's something you absolutely should be paying attention to. Rule 1.400.205 reads that when a sale or transfer of a practice occurs, you must submit a written request to each client requesting the client's consent to transfer the files to the successor firm, and the consent is presumed, meaning if you send the letter and they don't reply, the consent is presumed if they don't say no within a 90-day period. So really, you shouldn't transfer any client files within that 90-day window. And you can see why this might be a problem if somebody becomes incapacitated in February of a given year. That's a real problem. It's a really good idea to have this transition, this succession plan sort of in place and ready to go, because if something happens to you and you may be survived by a spouse or another plus one or another important person in your life, maybe a child, that is going to be a very difficult job for that person. So again, something to be very mindful of. This should be part of any sort of buy-sell agreement, but there is a 90-day wait period before that information is transferred. So discontinuation versus acquisition. So what we're talking here is closing the doors, right? That would be discontinuation. Acquisition of a practice by a member, meaning another CPA, that's if that practice is going to somebody else. So that is if you're selling your practice, maybe even, if you're selling that practice certainly to an outside person, these are the rules that are going to be covered. So you got to notify each client. If you're discontinuing a practice, you have to notify, and you have to make arrangements to return any client records as described in the revised records request interpretation under that Rule 1.400.200 and under the Act's discreditable rule under 1.400.001. If another firm is acquiring so if a target CPA firm's owner become equity partners, or the client notice requirements do not apply regardless of the percentage of ownership. So you could merge into another firm. That's really not going to apply. But if the target CPA owners are admitted as non-equity partners, okay, this is very important, the client written notice requirements do apply. So if you're an equity partner, If you're merging into another firm as an equity partner, no notice. But if you're merging in as a non-equity partner, and I think the gotcha here potentially is if you go with a publicly traded accountancy firm. So if you merge in that accountancy firm, it looks like you're going to be held to these standards because you're typically not an equity. I mean, I suppose you could be a shareholder, but you're typically a W-2 employee. You're not getting K-1'd on your income. But again, this is something really to pay attention to specifically on merging a CPA practice with another. So what does the end look like? So there are 4 paths, and I mentioned this at the beginning. There is transferring the business to a family member. That is what we call a passer, okay? So you're passing your practice maybe to a child, okay, maybe to a sibling. There's the outie. This is a transfer of a business to a third party. So you sell your CPA practice to a competitor or some other CPA firm. The innie is where you transfer the business to a key employee, typically for money, right? So the passer is typically a gift or it's an inheritance or some type of no consideration paid for the practice. That is the passer. So you can think of that's the freebie going to your family. The outie is a sale to a third party. The innie is to a sale to typically a key employee, potentially other partners. And then the squeezer is you extract as much value as you can from the practice and you close its doors. So you work it down until you have no more clients. You extract maximum value and end your practice. And I think you probably know people who have done. You probably are familiar with each of these different situations in different contexts. I think we're seeing a lot of squeezers because people are finding it difficult to, in many instances, the practice they built, there are no buyers. So there are no buyers at the price they want, and they figure, I'll just close the thing down. So let's go through each of these. So the passer is for no consideration. This means you're transferring your business for no money, typically to a family member. If the transfer involves money, and this does happen, right? Maybe the parent says, well, I don't want to just give it to my kids. I want my kids to pay me. We can debate whether that makes sense or not. But if it's for consideration, it looks a lot more like an innie transaction, so an inside transaction. And then we have an example here. Baker transfers to Baker's child, Sierra, Baker's interest in the business. If Sierra doesn't pay anything for the business, it's a gift. The basis carries over, of course, to the donee. We've got some gift tax issues in there. You have to value the business. Is that a reportable gift? Probably. How is that reported? Equalizing this sort of gift, this lifetime gift amongst the heirs. In California, we have a statute, a probate code section that says you can make an advance on the inheritance. So you can identify, hey, I'm giving you this business. It's worth $1 million. This will be an advance on your inheritance so that when I die, you're going to be dinged $1 million. And the recipient has to agree to that, right? So that's a written document that is drawn up by a lawyer that everyone signs, and that is an advance on the inheritance. That solves some capital gains tax issues, some other potentially income tax issues, but also goes to hopefully resolve this sort of equalization between the heirs. So when the parent passes away, the other 2 kids aren't. They say, well, you got mom or dad's practice, and that's not fair. So that helps to mitigate that issue with the family. To the extent Sierra pays anything for the business, it's a sale, and it looks more like an innie transfer, as we discussed. The outie is a sale to an outside party, and this is typically to the highest bidder, right? You do everything you need to do. You might use a broker, you might not use a broker. You're going to ready the business for sale. You're going to the buyer likely will want to keep the employees. Think about how hard it is to employ anyone in the accountancy space. And when the IRS said, oh, we're going to hire 80,000 new agents, new employees, I kind of got a chuckle. It's like my CPA says, I can't even hire 2. I don't know how they're going to hire 80,000. So the value of your staff, that could be a big component to a potential buyer, right? If that buyer needs those staff people, then that's going to be something that the buyer may be willing to pay a premium for, certainly. So you'd want to think about the people that are in your organization and whether they're of an age where they will want to retire when you retire. So it might be time to think about getting a group of people that would stick around who aren't ready to leave the business when you leave the business. And the seller may wish to keep the legacy intact. And we have an example here, Charlie, the Charlie CPA practice. I built this. My name's at the practice. You got to figure out if that's worth it to you. I think most people, when they're at the end and they're ready to say that's it on my career, I think a lot of people say, look, whatever you want to do with the practice. That's just in my real world experience. So now this is really important. When you're selling to an outside person, it's very important to ready your practice for sale. So obviously accurate financial statements is critical because The buyer's going to want to know, what is this? What's in here? Clean, organized, up-to-date financials. If you're a CPA, I really hope that you're actually, you're not the cobbler with the shoes, right? Who doesn't have any shoes, that you are keeping good financials in your practice. I think that's you probably higher probability than other businesses, because these buyers are going to want to scrutinize your profit and loss statements, balance sheets, tax returns, the whole 9 yards. Professional business valuation can help to determine the worth and can help in setting a fair price, and might attract a more serious buyer. I will say that I would be very careful on the business valuation. A lot of time, business valuations are done for gifting purposes, as you know, if you're familiar with this, your wealth transfer purposes. I think that's probably there's something else going on there. Sometimes the businesses are valued at death, and sometimes people want to have, would be happier with a higher valuation or lower. And sometimes people are getting divorced. So if this valuation is coming from a divorce case, the difference there is if you're a divorcing person and you're a CPA in a firm, you're not leaving that firm. Now you're not going to be married in the future, right? But you're not leaving that firm. So I think when a person leaves the firm, that's a different type of valuation. I'm just saying, as a lawyer, I would look at that and say, look, what's the likelihood that the clients are going to remain? What's the likelihood that the business is going to continue on as it had been in the past? So very important in business valuation. I'm not sure it's critical. I think a lot of people, I know we've acquired several practices, law practices. We're looking a lot more at the income and expenses, not so much a valuation on the practice, because we're doing our own valuation. So strong operational systems, very, very important. Documentation of all key business processes and operational systems, documentation of efficient procedures, that adds value. Now, some buyers may be buying the client list and say, you know what, that's fine. We just want your clients and we've got people to do the work. Other people might need the systems in place, at least if not just for a transition period, potentially a longer period of time. But I think that tends to increase the value of a practice. A solid customer base, very important. Is the base loyal? Is it diversified? Are all your billings coming from, half your billings coming from one client? I think a potential buyer would place a lower value, all things being equal, would place a lower value with a concentration in revenue on a particular client. And the evidence of a growing revenue stream, that adds value. It's better to be growing than it is to be shrinking. It's kind of obvious. Minimize owner dependence, very, very important. Does this business run without heavy reliance on the owner? That adds value. And this is really counterintuitive. I think the more complex stuff you're doing, in a way, the value could be less because you need that specialized expertise. Typically, it costs more. If you have the institutional knowledge and you've not shared that institutional knowledge with the other key people in your organization, I think that can tend to hurt the value. Again, I'm just saying this is reality, right? Ideally, the business should operate smoothly after you exit, and you can start by leaving. Now, I know this sounds counterintuitive, but you may want to leave. Maybe you leave a day a week a month a year. So that was I saw a speaker about 10 years ago say, if you leave a day a week and a week every month and a month every year, you're going to be working 50% of the time. So instead of working 2,000 hours a year, you're going to be working 1,000 hours a year. I will tell you that, again, all things being equal, if the owner is gone half the time, that actually makes that business worth more, right, than if that person's there working, and really the business is dependent on that person. Legal and regulatory compliance. Obviously, you've got to have, CPAs have their own regulatory compliance. You got to make sure and get through that. Again, the readying the business for its sale on an outside transition. What's your team and management structure? A strong management team and key employees identified to maintain this continuity post-sale. Critical. Identify them. Org chart, whatever it is. The more documentation, the better. A clear marketing and sales strategy. You may think, well, I'm a CPA. What marketing and sales strategy do we need? Well, I will tell you, it's good to have business owner clients. I think if you're watching this, I'm telling you something you've probably heard over and over again, and probably share that view. That may involve a marketing strategy. That may involve approaching, when I say sales, your ability to communicate effectively all the bundle of services that you could potentially offer to your existing clients or future clients, right? A scalable model with future potential is preferred. A lot of CPA firms are expanding their services, and I think it makes sense to take a look at that. Exit strategy and transition plan. Develop a clear exit strategy, right? outlining how the transition will occur, what steps are going to occur, who's going to do what, and then consider potential training or consulting during this transition phase. There are a lot of exit consultants out there, and it's probably something that would merit some consideration. So here's kind of what deals look like. If you're the seller, the deal wants the seller. If that's you, if you're selling your CPA practice, you want a big check with no contingencies and no earnout, and you get to go home and do something else, no strings attached, and a great price. That's what the seller want. What does the buyer want? Well, the buyer has the opposite perspective. They want to make you, as the seller, stick around and work slavishly with low or no down payment, pay over a long period of time with little risk to the buyer. Deals are done in between. All right. Broadly speaking, they're done somewhere in between, but those are the two goalposts, if you will. And we see this consistently in practice transitions. So let's look at an inside transaction. A sale to an innie. The innies may be the best. They may be the only potential purchasers. Now, there's a lot of aggregation happening in the CPA space, both large and small. I was just speaking just before doing this video with a good friend of mine whose firm was merged into a publicly traded CPA firm, a national firm. And I asked him, well, what size of firms get rolled up? You might have 5 or 6 people in an organization. So it's not necessarily a big organization. You might have a single person bringing in a book of business, right? But in any transaction, we see this quite often in the professional services space, where the next generation effectively takes over. Certainly, and we have an example on this, if you have a group of people and one leaves, that group buys out the other. That would be technically an innie transaction. But this can be implemented gradually over time, where ownership and control is transferred to innies in stages. It can happen if you have multiple partners. It could happen right away. It really just depends on the situation. If you're a sole owner, right, and you're worried about your own exit, and you kind of have maybe something that's kind of big, you're concerned about your legacy, you want your name out there, you need to train that group of people, that coterie of people who would be coming up after you or while you're working there, right? You need to get them trained, engaged, make sure they're on board with acquiring your practice, and that does take time, and that is gradual. Often these people lack the cash or collateral for a purchase, so you got to figure that out, right? And that is one of the big puzzles to figure out. And there are a lot of different ways to do it. So, like, say if a seller owns a practice and wants $1 million in their pocket, the buyers may have to earn $4 million, pay $2 million in taxes, turn around and pay $2 million to the seller, who then pays taxes and gets the seller's $1 million. So that's not an efficient process. It might make more sense for the seller maybe to have some type of retirement plan, cash balance pension plan, whatever it is, that fills up the bucket of retirement funds, so it's deductible to the organization. Sure, it's taxable to the person receiving it, but these are some ways where you can develop a transition strategy over time. And again, this takes time, this takes planning, this takes keeping people on in the practice over a longer period of time. So Charlie sells to Mike. Let's say Charlie CPA. Remember Charlie CPA? He was hit by the ice cream truck. Charlie CPA has a longtime key employee, Mike. Charlie and Mike create a buy-sell agreement. Charlie agrees to sell Charlie CPA practice to Mike in exchange for money, right? That's what most people want, is I'm going to give you the practice, I want money. Mike continues to be employed by Charlie Corp, the CPA practice. Then Mike owns later, as the deal finishes, as that transition it reaches its end, Mike owns the Charlie CPA practice. Now, is Mike going to rebrand that as Mike CPA practice? I don't know, right? But this is an example of an inside transaction, so it happens over time. Then there's the squeezer, this poor guy here. The squeezer squeezes every dollar from the business until its closure. This applies to a CPA practice. We see this all the time with lawyers, potentially other licensed professionals. But these are typically profitable businesses with significant cash flow. There may be no buyers in your geographic area or your industry. If you're in an industry, if you're doing a bunch of 1040s, I'm not sure there's a real market for that as much as there is if you're doing business returns, right? If you're doing a lot of partnership returns, corporate returns, and you have business clients, those are typically going to be a higher value, more attractive type practice. If there's a low barrier to entry for competitors, that's sometimes you end up with the squeezers. Now, I would say being a CPA or a lawyer is not necessarily a low barrier to entry, because you have to have the certification. But once you have that certification, it can just be you and a computer and a laptop. And there's not a big, not big capital expenditure to get into business. So I would say that's why we see some of these professionals as the squeezers, because there's, if you're in a community and there are two buyers and you close your practice, those two people are going to end up with a business anyway. I mean, that's kind of where we're going here with the low barrier to entry. If there's no innie who can take over, so if I would say if you're going to do an inside transaction and you say, hey, I'm going to hire someone, I'm going to mentor this person, and then that person's going to take over my practice. Hire three, okay? Make sure they want to be business owners because stuff happens, and I can't tell you how many lawyers I've talked to. They reach out to me, they say, Jim, I had this person in place to take over my practice, and then something happened. The person's 42, they had a stroke, real case. Person, moved. Their spouse got a good job and they moved. So a lot of reasons why, if you're kind of putting all your eggs in one basket with a single person, you may want to have more than one person. The smaller the business, the greater the potential for a squeezer. And Charlie CPAs decides that the best path, so it's kind of changing our example here. Let's say Charlie says, I'm not going to sell the mic. Charlie decides the best practice path to exit is his practice is for Charlie to extract the maximum value, then close the practice and transfer the shell of the business for little or no consideration. So whatever happens to be left. This can happen with a lot of professional service providers that are heavily dependent on the exiting owner. And if that's you, you know who you are, okay? If you're saying, oh man, that's me. It's like, I'm the only person who can do this. And it's too hard to train somebody. I think you might have a higher probability of end up being a squeezer. The other one is maybe an outside transaction. So this might be if you say, gee, I can't find anyone to take over my area of practice, look at merging into a bigger firm. There are a lot of, as I mentioned, these national accounting firms. Just pick up the phone and call the people who are in charge of bringing on new business development. I mean, those are the people you want to reach out to, and I'm sure they're happy to have a conversation. Why is estate planning important for business owners, even CPAs? So if you're a CPA, you go, well, I'm not a business owner. I'm in a professional practice. Well, if you're making payroll, I think you're a business owner. So it's extremely important. What if you have a business partner? Okay, let's talk about business partners. If your partner dies, do you want to be in business with their heirs, their spouse, right? Is that what you really want to do? If your business partner files for bankruptcy, do you want the trustee in bankruptcy to be your business partner? Okay. Now, hopefully that doesn't happen, but it can happen. The leading cause of bankruptcy in the United States is health debt, so debt related to health expenditures. If your business partner divorces, do you want to be in business with their ex-spouse? Potentially. If your business partner strokes out, as we say, do you want to be in business with the conservatorship court or their successor trustee? So these are reasons to have a plan. Okay, what we're talking about is like a buy-sell or some type of succession planning. This really starts with estate planning. I'm not going to spend a whole lot of time on this. This is one of our core service offerings. Most of our clients, almost all of our clients, except for rare exception, a revocable living trust is the sort of foundation. It's the core of the estate plan. You do have to pay attention to beneficiary designations on things like life insurance, annuities, and 401ks. Those do not go in the trust. The people who get that money when the person passes away are the people who are the named beneficiaries on the documents that are at the institutions, in their facilities, in their records. And it really doesn't matter what your living trust says. The beneficiary of life insurance, 401k, annuity is going to be the person that, the decedent, right? If it's your IRA, it's going to be the person you named on your IRA and you signed that document. There's pour over will is a will that leaves everything to a trust. Deeds, advanced healthcare directives, durable powers of attorney. We cover this in other webinars, but it's very important. If you don't have a living trust in place or it's outdated, pay attention to that. Certainly if you're a business owner or CPA. So how does a living trust work? I really hope this is a review if you're a CPA watching this, but you might not be. You might be the spouse of a CPA. You might be the child. Living trust is like a bucket, right? It's a bucket with a handle. The trustee is the person in charge. It's like the president of the trust. That trustee is holding on to the handle. And then what you do is you put your house, stocks, bonds, and mutual funds into the trust bucket. And when that trustee, which is you, I mean, I have a living trust, it's a bucket, I put my house in my trust, I'm holding onto the handle as trustee. When I stop being trustee, that bucket passes to the successor trustee. So that is what is called trust administration. When that bucket passes to the successor trustee, the person named as the successor trustee, we drop the term successor, that person becomes trustee. That happens outside of probate court. That happens outside of the court system. And that's very important because it's much more efficient and much more economical. And a trust is better than a will because a trust can take care of you and your assets while you're alive. A will is only effective at death. So if you say, gee, in my will, I'm going to leave everything thus and such, well, that is not even an effective legal document until you pass away. So in order for a will to be effective, that person has to pass away. A living trust is effective from the get-go. Now, there are strategies within the living trust to protect the people who inherit from you, your heirs, from divorce taxes, some wealth transfer taxes and lawsuits. And revocable trusts typically become irrevocable at death. So you're not getting a separate taxpayer identification number for your living trust. That happens after a person passes away. Probate's bad. If you've been through probate, it's a living hell. Normal probate takes 16 to 24 months. The fees are 4 to 8% on the gross value of the asset. So if you have a house that's worth $1 million and a $950,000 mortgage, the probate fees are still $50,000. That wipes out, that's like a 100% probate fee. And probate's a public process. Probate is designed to pay creditors. Living trusts are designed to provide for beneficiaries. These are structural differences. And for those reasons, we typically recommend that clients use the revocable living trust as a chassis. And we do have a probate calculator on our website. You can go and figure out, oh, probate on a $3 million estate, the attorney's fee is $43,000, the executor compensation is $86,000. Certainly if it's a living trust, trust administration's off 95% of the time, far less in fees. So what is business succession planning? Business succession planning is a strategy for identifying and developing future leaders. This is not a document, right? This is you identifying, using your brain, thinking about the who, right? The who decisions in life are the most important decisions. Who you marry, pretty important decision. Who your business partner is, pretty important decision. Who's going to take over your business? I would say that's a really important decision. The documents are kind of secondary. This is not about writing up documents and putting it in the drawer, but you need to identify those future people in your organization, or maybe those other aggregators or the other people out there who are acquiring CPA practices, and make sure it's the right fit, and and help your business prepare for all the contingencies by preparing high potential workers for advancement. So this is really key. I'm Gen X. There are a lot of baby boomers retiring, and there are a lot of millennials in the workforce. In fact, the millennials are higher in number than the baby boomers. As a Gen Xer, I kind of feel like I'm sort of facilitating the transfer of these businesses from boomers and shepherding that transition to the millennials, because there really aren't that many Gen Xers. So we're kind of a smaller population. And I think identifying the millennials, and this may be hard to get your head around, if you're a boomer and you say, oh, those millennials, they, all these problems or whatever it is, those are probably the people who are going to be taking over your business or your clients or whatever it is in the future, and preparing those people to be great professionals, to be great CPAs, to be, and if you're a lawyer, great lawyers. I think that's really, really important. And it requires a shift from being an individual contributor in many instances of, hey, I'm going to meet with this client, I'm going to do this work. It requires you to bring in another person and mentor that person and train them to handle the things, so that when you leave, there's another person coming in to get that work done. And this is not only for an inside transaction, but it's also if you were to merge your firm into a larger CPA firm. That's really important, because those bigger firms need people too, right? They typically are they're going to keep the good people largely, but the bad people, different story. So the key documents in business succession planning. So if you're thinking about business succession planning, what are some of the documents, just to familiarize yourself with key terms? Powers of attorney. A power of attorney is a very important document. A power of attorney is valid while the principal who creates a power of attorney, while that person's alive. Buy-sell agreements. We're going to talk about the two big, the forks in the road on the buy-sell agreement. Non-disclosure agreements, very, very important. Non-solicitation agreements. If you are shopping your CPA practice to other buyers, you want to make sure that they don't poach your people, right? Because they may just want to, if you don't sign a non-solicitation agreement, then they're free to poach your people. So very important to nail that down. And then general estate planning documents for all the owners of the business or CPA practice, including an appropriately funded revocable living trust, holding company, irrevocable trust, or other types of trust and entities. And we cover that in other in other videos. So this is like buy-sell agreements 101, okay? A buy-sell agreement is an agreement that stipulates how a partner share of a business may be transferred in the event of the partner's death or departure, so also called separation. This may establish a method for valuation. It is not required to establish a method for valuation. So there are two big ways to do this. One is a cross-purchase agreement. So this allows the remaining owners, the remaining partners, to buy the interest of a deceased or selling owner or exiting owner. And we'll have an example on that. So that's where another person is buying out another partner's interest, right? A redemption agreement requires the partnership or the business entity to buy the interest of the deceased or selling or exiting owner. So instead of an individual buying that partner share, the partnership itself buys out the exiting partner. And that's typically in a larger organization for obvious reasons. Then there's a wait and see. And, this is kind of the hybrid. And that gives the business owner or other owners flexibility in allowing for them to decide at the triggering event, right? When the separation occurs, when there's an incapacity or death, that allows the remaining owners to buy out that person's share or the business itself. And there might be some operational reasons why you might want to buy out why one partner might want to buy out another partner and incorporate that into their book of business. Again, that's called a wait and see. And this can be a combination of two. Often this is funded with life insurance. It doesn't have to be funded with life insurance, but oftentimes it is funded with life insurance. It can be very cheap and resolve a lot of problems for the remaining partners, right? So let's look. Mike and Oscar are partners in MOCPAs, an accountancy firm with $2 million in annual revenue. Now, I just picked a number just so I can explain a concept, because $2 million is not a whole lot for an accountancy firm, right? I mean, it might be where you are, but for many accountancy firms, it's not that big of a number. Mike and Oscar create a cross-purchase buy-sell agreement funded with $1 million of life insurance on each of Mike and Oscar. So it's very important, $2 million business. And let's say we're just valuing this at one time's earnings, so $2 million in revenue. You can put any number you want in there for valuation for buy-sell, funded by a policy of life insurance on each partner. They're 50-50 partners. Mike dies. Oscar, so this insurance is on Mike's life. Oscar gets the death benefit, okay? And Oscar is contractually obligated to pay that death benefit to Mike's living trust, and Oscar continues with the practice. So let me say this another way. Mike and Oscar are partners. Mike dies. Mike's life insurance pays to Oscar, and then Oscar is required to give that money to Mike's living trust in exchange for Mike's half of the business, okay? Very important you get that sequencing correct. There was kind of a well-known case when I was a very new attorney in Southern California where this got messed up, and it was two CPAs, and the surviving CPA ended up with the practice and the life insurance, okay? Because the buy-sell agreement was not properly written. So it happens more often than you might think. So this is often used in smaller businesses and professional practices where one or more owners are buying out an exiting owner. And again, this is the partner buying out another partner, not the partnership buying out the exiting owner's interest. So another example: Alpha Delta Echo Foxtrot Golf Hotel India Juliet Kilo and Mike are partners in A to M CPAs with $10 million in revenue. So 10 million, 10 partners. A redemption buy-sell agreement is created. Alpha dies. His $1 million stake in A to M CPAs is purchased by A to M CPAs, and Alpha's living trust gets $1 million. Now, this is probably a lot easier. I mean, this might be funded with life insurance. The partnership might just write a check for $1 million, go to a bank, borrow the money. You got retained earnings. You take those retained earnings and you buy them out, right? A to M CPAs is contractually obligated to pay this $1 million to Alpha's trust, and the CPA practice carries on. This is often seen in larger practices and businesses where it's just simpler for the business to fund the buyout. Now, certainly Delta could have bought out Alpha's shares, right? Maybe they did a wait and see. So again, this is case specific. This is why you want to work with an expert attorney, like an attorney at our law firm, Cunningham Legal. We do this all the time. So planning for the eventual exit is a process. It is not an event. Do not start the planning when the letter of intent arrives. So you probably see this with your clients. They say, hey, I sold my business last week. I need to do some tax planning. That's tough. Have a plan in place. It increases the value of your company before you leave it. And so let's talk about some best practices on maximizing value. So what are some things that you can do now or maybe the next 5 years to maximize value in your practice? I would say some things not to do, some mistakes is not engaging your A team early on. Now, what do I mean by A team? I remember the show from the 80s, A team, and there was one recently, but I'm talking about the 80s A team, right? With Mr. T, and they had that van. It was really cool. That was the team you called, right? When you had a problem. So you need to engage your A team well in advance. Now, what is your A team? Your CPA. Yeah, if your CPA, it might be you, might be one of your partners. Your attorney, your estate planning attorney, M&A attorney, tax planning attorney, or tax planning professional, your corporate attorney. Now, sometimes these are all in the same firm, and then other affiliated professionals. You might have a real estate broker, appraisers, you might have some regulatory advisors, whatever it is. But think about this. So if you say, gee, I'd like to exit my practice in 7 years, start that now. Don't wait for 6 years or 7 years. And by the way, when people say, oh, I'm going to retire in 5 years, in my mind, I'm thinking they have no plan. Because if you talk to them next year, what are they going to say? Oh, I'm going to retire in 5 years. So go figure. Macroeconomic factors. So what are we talking about here? We're talking about the economy at large. So do you just watch the news or Google what's out there? It's very important to understand key macroeconomic trends. We live in a consumer-centric economy. And whether your business is business to business, business to consumer, business to government, not everyone, and this is very important, not everyone is on the same business cycle. And so some may lead or lag or be on top of consumer trends. And you need to understand how your business, if it's your CPA practice, how does it relate to macroeconomic trends? I would also say your CPA practice is subject to demographic trends, meaning there aren't a lot of people coming out of college wanting to be CPAs. The age of CPAs is getting higher and higher, which means you may need to be more competitive in the marketplace to attract the younger people who are CPAs, which means you may have to pay them a lot more money. That's the bottom line. And you probably have seen this in your own practice, is this wage inflation where people are making more and more money. Figure out where the economy is going and how it fits into your overall cycle. Now, an example would be, now this is not a CPA example, but if you pay attention to how many miles are driven in economic reports and forecasts, if you have an auto body repair shop, there is a certain number of accidents per mile driven. The more miles that are driven, the more accidents, the more damage, the more business you're going to have. So if you're seeing a trend going up and you're counseling a collision repair shop and you say, gee, people are moving into your area, miles driven is going up, there's an opportunity here. You're going to be getting more business, right? Your total addressable market's increasing. So something you really to pay attention to. Kimberly Clark, this is an example of good to great, the great Jim Collins book, The Closing of the Mills. And under the CEO, Darwin Smith, this was in the late 60s, early 70s, they sold all the company's paper mills despite being core to their business. So they used to make paper, like for, office paper. They shifted their focus to consumer products like Kleenex. And this was a very risky decision and very controversial, but led to long-term success. So this is a bold move where they closed the mills. This, I would say the parallel to this is if you say, we're not going to do 1040s. If you have a business owner, sure, we'll do a 1040. But if someone just walks in off the street, we're not doing 1040s anymore. I would say that's really kind of a Kimberly Clark move. And that probably is for business, depending on where you are in the country, right? That likely is a good business move, right? Because you want to get the higher, you want to have the opportunity to add more value for your clients versus not, right? Leaders have to be willing to let go of legacy parts of their business to pursue greatness. They need to identify the things that are dragging them down. And it might be if you're doing bill pay as a CPA and there's technology can do it cheaper. Does that make sense to keep doing it? You may want to repurpose those people to a higher and better use. But this is a highly individual decision. But again, people have made this decision in the past. Kimberly Clark has had this closing the mills moment. And, we're all human living in the world. We have our own versions of this. And I know in law, we look at this quite a bit. But I think discipline focused choices that are what drive transformation. You need to really pay attention to this and it's not just business as usual. The world's changing, right? So, CPA succession planning. Let's remember Charlie. Charlie, the CPA, spent years building Charlie's CPA practice from the ground up, and Charlie did thorough estate planning and business succession planning when Charlie is finally hit by that ice cream truck. while crossing the street and dies. Charlie's family isn't stuck in probate court. Charlie passes the business to his key employee, Mike, and Charlie's family remains financially secure. So this was the inside transaction. So there can be a good outcome, not for Charlie because he got hit by the ice cream truck, but it is good outcome for his family. So again, the key takeaways from today, business succession planning, the 4 business succession paths are the passer. This is your business going to a family member. The outie, this is going a sale to a third party. The innie, which is a sale to a key employee, so an inside transaction. The squeezer, that's where you just wring out as much value and close it down. Don't forget about the importance of estate planning, the importance of business succession planning, and also the legal considerations for CPAs transferring their practice. So there are specific rules that apply to you. If you're watching this on YouTube, please subscribe to our YouTube channel before we go. And thank you for joining us today. And please check out our other videos on YouTube. And please post comments. We love to see those comments.